You know that feeling when you find a place that just gets it? I've been chasing this bowl for 3 weeks. The steam hits your face and you can already taste the broth. But here's what nobody tells you about street noodles. The best ones are always surrounded by chaos, and somehow that's exactly what makes it perfect. Smart investors explore different types of investments. Stocks represent ownership in the company. Bonds are considered safer than many stocks. Real estate can create passive income and appreciation. Mutual funds allow investors to diversify easily. Exchange traded funds are popular because of low fees. Cryptocurrency remains a high risk investment in 2026. Gold is often used as protection during inflation. Dividend stocks provide regular income to investors. Index funds are widely recommended for beginners. Technology investments continue to influence global markets. Artificial intelligence companies attract major investors. Renewable energy stocks are growing rapidly. Healthcare investments remain important because of aging populations. Smart investors understand the risk level of each asset. High returns usually come with higher risk. Diversified portfolios reduce the impact of market crashes. You should avoid putting all your money into one investment. Real estate investment trusts offer property exposure without buying buildings. Treasury bonds are often used for portfolio stability. Smart investors compare fees before investing. High management fees can reduce long-term profits. Understanding liquidity helps investors access cash quickly. Some investments are easier to sell than others. Investors should study historical performance carefully. Past performance does not guarantee future results. Growth stocks focus on expansion instead of dividends. Value stocks may trade below their actual worth. Blue chip companies are known for stability. International investments can increase diversification. Currency changes can affect global investment returns. Emerging markets may offer high growth potential. Smart investors research industries before investing. Understanding business models improves investment choices. Environmental trends can influence future markets. Digital banking has changed modern investing. Investment apps make investing easier for beginners. Fractional shares allow people to invest with small amounts. Smart investors compare risk and reward carefully. Defensive investments help during economic downturns. Aggressive investments may perform better during growth periods. Portfolio balance depends on financial goals. Younger investors often take more investment risks. Older investors usually focus more on stability. Smart investors regularly rebalance their portfolios. Economic news can influence market movements. Interest rates affect stock and bond prices differently. Inflation can reduce the value of cash savings. Smart investors keep learning about financial markets. Understanding investment categories improves decision making. Every investment carries some level of uncertainty. Research reduces unnecessary investing mistakes, and smart investors think long term instead of chasing trends. The best investment strategy matches your personal goals. Understanding investment options is essential for success in 2026. A strong investment strategy provides financial direction. Smart investors create goals before investing money. Your strategy should match your risk tolerance. Risk tolerance depends on age and financial situation. Long-term investors usually ignore short-term market noise. Smart investors focus on consistent growth. Dollar cost averaging reduces the impact of market volatility. Investing regularly builds wealth over time. A monthly investment habit creates financial discipline. Smart investors review their portfolios consistently. Asset allocation determines how money is distributed. Stocks often provide higher growth potential. Bonds can reduce portfolio volatility. Cash reserves provide financial security. Diversification improves portfolio stability. Smart investors avoid emotional trading. Panic selling often leads to financial losses. Greed can cause investors to take unnecessary risks. Having clear rules improves investment decisions. Stop-loss strategies help manage risk. Smart investors understand market cycles. Bull markets create strong investor confidence. Bear markets test emotional discipline. Economic recessions can create buying opportunities. Smart investors focus on long-term trends. Artificial intelligence is changing investment research. Data analysis tools help investors make informed decisions. Smart investors study company leadership carefully. Strong management teams often improve company performance. Earnings growth is an important investment indicator. Revenue trends help evaluate business strength. Investors should understand debt levels in companies. Strong cash flow improves business stability. Smart investors compare companies within industries. Market competition affects long-term profitability. Investment journals help track financial decisions. Reviewing mistakes improves future strategies. Smart investors adapt to changing economic conditions. Flexibility is important during uncertain markets. Long-term planning creates financial confidence. Investors should avoid chasing viral stock trends. Social media hype can create dangerous bubbles. Smart investors trust research instead of rumors. Financial education Diversification increases investing confidence. Portfolio reviews should happen several times each year. Rebalancing keeps investments aligned with goals. Retirement planning should begin early. Smart investors prepare for unexpected financial events. Insurance can protect long-term financial stability. Multiple income streams increase investing opportunities. Side businesses can support investment growth. Smart investors continue improving their financial skills. Patience and discipline are essential for investing success. A strong strategy reduces unnecessary financial stress. Smart investing in 2026 requires planning and consistency. Many investors lose money because of emotional decisions. Fear often causes people to sell investments too early. Greed can push investors toward dangerous risks. Smart investors avoid chasing unrealistic profits. Investing without research is extremely risky. Blindly following online influences can be dangerous. Smart investors verify financial information carefully. Market hype often creates temporary price bubbles. FOMO can lead to poor investment choices. Patience helps investors avoid impulsive decisions. Smart investors understand that losses are normal. Every market experiences periods of decline. Overconfidence can damage investment performance. Diversification reduces the risk of major losses. Putting all your money into one stock is risky. Long-term investing is one of the most powerful wealth-building tools. Smart investors think in years instead of days. Consistent investing creates financial momentum. Building wealth requires patience and discipline. Compound growth rewards long-term investors. Reinvesting profits can accelerate portfolio growth. Smart investors create multiple income streams. Dividend income can support financial freedom. Real estate can generate passive cash flow. Businesses can provide additional investment capital. Smart investors continue learning throughout life. Financial education improves decision making. Economic conditions constantly change over time. Successful investors adapt to market trends. Artificial intelligence is transforming global industries. Technology investments may shape the future economy. Renewable energy continues attracting global investment. Healthcare innovation creates new financial opportunities. Smart investors monitor global economic developments. Inflation affects the value of money over time. Protecting purchasing power is financially important. Diversification helps maintain portfolio stability. Strong financial habits support long-term success. Saving regularly increases investment opportunities. Smart investors avoid unnecessary lifestyle inflation. Spending less can increase investment capital. Retirement planning should begin as early as possible. Early investing provides greater compound growth. Smart investors create realistic financial goals. Clear goals improve financial motivation. Investment plans should be reviewed regularly. Market changes may require strategic adjustments. Smart investors stay calm during volatility. Emotional control improves financial performance. Long-term wealth is built through consistency. Smart investors avoid trying to predict every market move. Timing the market is extremely difficult. Staying invested often produces stronger returns. Financial independence creates more life opportunities. Smart investors prioritize long-term security. Wealth can provide freedom and flexibility. Giving back becomes easier with financial stability. Family financial planning is extremely important. Smart investors teach financial skills to future generations. Strong money habits can change entire families. Building wealth requires focus and persistence. Financial setbacks should become learning experiences. Smart investors remain committed to their goals. Discipline often matters more than talent. Investment success comes from consistent, smart decisions. Smart investors understand the importance of patience. Long-term strategies reduce emotional stress. Every financial decision shapes your future. Becoming a smart investor in 2026 is achievable with dedication. The journey to financial freedom begins with taking action today.